Hello, and thanks for tuning in. You are here for SRP Market Insights, third quarter for 2023. We hope that we can help you unpack what's going on in the market. We're excited that you are taking the time to be with us today, and we think we've got some good information to share. Bob?
All righty. This slide hasn't changed much over the years, but I just want to cover real quickly cover the headwinds and tailwinds. Don't want to spend too much time here. The nice thing is, as far as the headwind, the bad thing about the headwinds is inflation still has remained relatively high, and interest rates continue to go higher. Earnings have become a little bit more challenged. One interesting thing is you see in the headwinds, I have expansive fiscal policy for both headwinds and tailwinds. The expansive fiscal policy creates a problem for the Fed, so it kind of keeps up inflation, so it can be viewed as a headwind. However, expansive fiscal policy is spending, so it continues to prop up growth. So you've got kind of a double-edged sword there. As you know, we have increasing banking regulations, and as for Silicon Valley Bank, at least the smaller local banks have been a lot more tight with their lending. OPEC, even though oil prices have been falling, OPEC and this oil supply still present a concern. And we continue to have a war over in Russia and Ukraine. That seems to be getting actually worse. And then we seem to have a little bit of increased tension with China and Taiwan. Those are the headwinds. Tailwinds, though, we have a relatively resilient consumer. They've been spending down their savings, and driving up their credit card debt, but they've been spending, and they continue to have jobs. 2022 was one of the worst years on record. So what we're getting is a nice bounce off of a very big low. Markets tend to rally after inflation and interest rates peak, and it looks like we may be coming to the peak of interest rates. Fixed income is now offering some decent income. And then looking forward, some of the news has been turning a little bit positive. There's been a lot of buzz about AI being, driving expectations of higher growth in the future. We're in the second part of the presidential cycle. That typically is positive for the market. And once again, I already covered expensive fiscal policy. So those are the headwinds and the tailwinds. There's a lot of cross currents, and we're going to dig into those a little bit deeper coming up here. Now, this is one of the headwinds. There's a lot of uncertainty about what's going on in the real estate market, and this is one of those kind of risks out there that are hard to discount. But it's starting to weigh a little bit of concerns on the market because real estate's a big part of the economy. The graphic on the left here is one of the most interesting graphics I could find on this. And what it does is it takes the office space and stacks it one on top of the other. When you do that, it literally reaches 100 miles in the atmosphere, all the way up to the thermosphere. There's 48,000 floors not being rented. And if you take a look at how that goes throughout the country, New York has a 16% vacancy rate, 76 million square feet just sitting vacant. If you take a look at the major cities as far as the maximum or the highest percentage, San Francisco has 26% vacancy rate. Now, those are kind of hard to put into context. But if you take a look on the average, since pre-COVID levels, vacancy rates have increased by about 33%. So it is a big number. However, real estate isn't uniform. There's a lot of things going on in the real estate market that are positive and negative. Sure, there's struggling areas like the malls. They got hit by the Amazon effect. Retail, office spaces, urban centers, those have been really hit with COVID and all sorts of other things driving those values down. But then you have other areas that are surging. You've got the data centers, the warehouses, the logistic hubs. You got single and multifamily homes. And then you take a look at what's been happening as far as the investments. Real estate's been a decent investment, so a lot of investors have been getting into the real estate market, propping up their values. You've got migration from the north to the south. You've got private equity buying. You've got foreign buyers. But the big question coming up is, what happens with the re-up rates when all these leases come due? Do the prices start going higher? Does it make things worse, or do they actually get better?
Bob, what's interesting, you've talked about it in past market insights, is the banking and the financial sector too and how this could possibly spin toward that if there are a lot of the holders of it. And so you've seen energy cool off, you've seen financials cool off like year to date. This is a potential bubble, and that's all on the value side. And we've already seen dramatic, it was coming from a bad year for growth last year, but with the AI interest and those other things weighing down value, it's been such a dramatic performance difference inside of the US stock market. It's just interesting to see if that keeps going.
Yeah, and that's why I say this is like one of those risk things that's hard to discount because, like we saw recently, there was a $400 million property in San Francisco that was just handed back to the bank. And if that becomes a trend, that could be some real problems for our banking system.
And I won't get you started on China, but there are some empty places in China too. So, we'll see how it plays out across the globe. All right, Bob.
This has been one of those years where we're climbing like a wall of worry. It's been one of those really interesting years where things look kind of bad. Everyone's talking about a recession. Rates are going higher. So what does the market do? Rally strongly, right? But if you take a look at underneath the hood, the economy is really not doing that well. And it's been by design. The Fed's been increasing rates to kind of cool things down. But if you take a look at the LEI here, you can see there's very few things that are positive. Back when this was produced, there were just three. There's stock prices, right, which has been feeding the wealth effect. You've got building permits. Housing has been strong for single family and multifamily. And then you got unemployment claims. The unemployment market remains, the labor market remains strong largely because there's a labor shortage. But, overall, many of the other factors are looking weak. And typically, once the LEI rolls over and goes negative, typically you do get a recession in the future. And so, this is just one of those things that are kind of like pointing, we probably are going to have a recession. I just got the most recent update today on this, and there's only one factor still pointing positive. So if you take a look at what are the arguments for a recession, we've got a growing delinquency rate. We've got a struggling economic growth. We've got an inverted yield curve. We've got struggling real wages. We expect more Fed rate hikes. The Fed thinks they might do 2 or 3 more. The market's telling you 1, but at least we're probably going to get 1. The LEI is negative, and the sentiment is near a record low. Where are the positive things? Well, the bond yield, high yield spreads haven't really signaled any kind of a warning yet. Household balance sheets, even though they're burning down the salaries, people still have their jobs. They have some cash on the sideline. The stock market and their housing prices have been going higher, so the balance sheets are okay. We have low unemployment. It's hard to have a recession when you have low unemployment. It's hard to have a recession when you have relatively high inflation. We have a strong housing market. We still have positive economic growth, and it looks like inflation is peaking as well as interest rates. And so there's some things that they're saying not so fast on the recession side.
Yep, for sure. And on that front, Bob, it's climbing the wall of worry. And Jeff's talked about it in the past. Is the market is looking out 12 months. So even though the rates are high, it's possible the Fed, surprising to many, could have threaded the needle in terms of as rates are going down at the right time. Markets see that, and that would be a positive boost. And you've talked about it, Jeff, just in terms of kind of comparing it to markets versus what the real economy is doing, and when the market has trouble, what the early innings versus the late innings look like in a market cycle. I mean, do you have any thoughts on that? Or
yeah, well, I'm trying to remember an analogous period of time, but can't really come up with one in my head where we're coming out of a lull. We've had a tremendous amount of government spending, and that fiscal imbalance is still driving us forward with continued growth, continued inflation, and those things. But yet that leverage and pressure that it will eventually put on the taxpayer is significant because that fiscal imbalance is so ginormous. And so that's a technical term. So, it's just, if that fiscal imbalance wasn't there, would we already be into recession? I think the answer is probably yes, right? That it's kind of keeping us going. So, but that's not sustainable. So it's kind of twisting things, I think. And it looks like we're going to get the soft landing that the Fed promised us all along, which a year ago we chuckled and thought that was kind of laughable that we would get a soft landing. But with this huge fiscal imbalance, we may very well get it yet.
Yep, for sure. I think this is you, Bob, or do you mind chatting on this one?
Sure. Now, this is the talking points over to the right are the same as far as a recession, yes, and recession, no. But these are some of my, at least the top one here is one of my favorite ones to watch for as far as, what the market's really thinking. I'm always trying to look for market indicators to tell me what the market's thinking. Well, one of my favorite ones is the spread between high yield bond rates. Now, normally they tell you that the bond market will sniff out a recession or danger ahead far quicker than the equity market. The problem with this option adjusted spread now, however, is that we've just gotten through a period of record low interest rates. So the high yield companies, which are the lower quality companies, they've had plenty of time to refinance, to redo their balance sheets with much lower interest rates. So I was just reading the other day how the interest coverage of high yield companies is near a record high, which is a very strong thing. So the high yield option spread, interest rate spreads may not be as good of an indicator of sniffing out danger as it used to be because, like I said, they've been able to refinance it. But once again, it's something that we keep an eye on. The other one is the delinquency rate. The delinquency rate is like a canary in the coal mine. When people really start to struggle, they stop paying their credit cards. Well, as you can see from the bottom one there, interest rates have started to creep up. I mean, the delinquency rates have started to creep up, but they're not anywhere near you really start to worry. So this is one of those situations where you can see things maybe starting to get worse, but they aren't to the levels where you'd really be concerned. If you take a look at that chart, look at the peak back in 2009. You're up near 7% delinquency rate. We're still below 3%. So it's a little early warning sign to watch, but so far the markets are telling you, you're in pretty good shape.
Yeah, Bob, don't you think that if some of the predictions are accurate and that we continue this fiscal imbalance, which is going to enable a soft landing and also probably keep inflation a little on the higher side, we could experience interest rates at a higher level for much longer than people originally anticipated. And that's where it's going to start to bite some of these two parties, right? It's going to start to bite people with credit card debt and high yield debt, because eventually when that refinance from 5 years ago rolls off the books and they have to refi at higher rates, that's when we'll see both of these things really start to spike if interest rates stay longer than people are anticipating.
Yeah, and that's what we've been saying ever from the get-go, as far as expect higher interest rates for longer. And if the dollar starts to weaken, expect inflation to stay higher longer. And as we're doing this nearshoring, friendshoring, and onshoring, that's also inflationary. So as we, there's a whole, and of course the labor shortage is inflationary. So there's a whole slew of macro developments that are probably, regardless of what the Fed does, it's probably going to result in higher inflation going forward, simply because, China was the greatest way for us to keep inflation down. We're getting away from that.
Yep. It is crazy that we're talking about that, being that we were at zero interest rates in the basement for so long, and now it could hover higher than people thought. So it's very interesting. Jeff, do you mind talking about this?
Yeah. So over on the left, what that chart shows is the price to earnings ratio in green of the top 10 stocks in the S&P 500. And so you can see going into 2000s, those top 10 internet stocks with the subsequent crash that came after, we see that PE crashing. And then we know coming out of that, the internet companies that ended up being the top performers post 2000, many of them weren't even around when that initial run up occurred. So now we see a run up occurring all over again. Largely recently, initially in COVID, it happened because people were home and a captive audience for the technology platforms that are in the marketplace. Now it's more so focused around the idea that artificial intelligence is going to propel those companies even higher than where they are now. So just understanding that, what comes up must come down. So in the long run, in the middle there, you'll see that today those top 10 stocks make up 32% of the S&P 500. It's a pretty staggering thing to get your head around, that you're in an index with 500 stocks and 32, almost a third, is just in the top 10. And then you can see down below there, the earnings contribution from those companies, though, is only 22%. So earnings growth being down, that is always a concern.
Looking at this chart, looking at that chart, I'm experiencing post-traumatic stress syndrome, because I got into portfolio management right when that chart starts back in '97. So I was able to ride that up. And at one time, it was called Wintel back then. Windows and Intel made up 40% of the NASDAQ 100, and we were heavily invested in that. And so we looked like geniuses for about 2 years. And then
and it's you mentioned it. I mean, it's hard, or there isn't a comp for what you're seeing right now. I mean, there's certain attributes, but you were mentioning it, Jeff. It's just it's been manipulated, and there's just so many factors that are artificial or strong macro factors. It's hard to find historical comps, but.
Yeah, this is a chart here that gives me some hope that maybe this market does have some legs. Maybe we are gonna get a soft landing and be in okay shape. And the stack on the left was the year-to-date return through the end of May. And you can see that nearly 100% of the return of the S&P 500 during the first 5 months of the year was attributed to just 7 companies, which is hard to imagine. So once again, you're in an index with 500 companies, and 100% of your return is really just 7 companies. And then over here to the right of that, we can see that since the end of May, the returns of the S&P 500 are much more broad-based. So it's not just those companies, that there are many other companies that are participating. That to me is a pretty good sign that market optimism is coming back a little bit. And then in that middle chart, you'll see that it's the equal weight index, which assumes you invest the same amount of money in each company in the S&P 500 versus the index itself. So that equal weight index has actually outperformed since June 1st, which just shows that it is a much more broad-based rally than what we saw prior the last few years.
Mm-hmm.
Yeah, there's. I was just going to add one little additional note there. One thing different about back in 2000, and when you see this, Tesla, Meta, Amazon, they have earnings. Back in 2000, most of those companies didn't have earnings. I mean, there were some like Wintel, but most of those other ones didn't have earnings. It was pure hype.
For sure. And last was just looking at the globe from an equity and a bond perspective, because it really is in many cases about asset flow and where investment assets want to go, in what direction and what markets do they boost. So on the top here, you'll see the bar graphs of S&P 500 on the left, and the MS ACWI XUS, which is the international index for everything outside the US from a stock perspective. They highlighted a couple of the areas. In particular, you can see the large difference in the greens between US S&P is very tech heavy and not so much in the terms of the international. And that's been a driver for sure. And it's going to be interesting to see how that plays out when AI works its way through and who the winners are there. So that's one factor that has been boosting US versus the international. And then on the bottom, you see the bond yields. So, Bob, you were talking about it earlier. U.S. Fed did get ahead of inflation more than some other areas across the globe. And so our rates may be able to go down, and it's going to be a tug of war in terms of how the U.S. dollar goes and which stock markets win out versus the others. Did you have any, thoughts on that? Quick thought on it?
Yeah, I mean, I think this is one of the most interesting stories out there because we got ahead on the interest rate cycle versus the rest of the world. If you remember, we started increasing rates faster than Europe. That rally in the dollar was extreme last year. However, now that we're reaching the peak of interest rates, our interest rates are probably going to start going lower while Europe keeps going higher. That pulls the rug out from what was supporting the dollar. So now we may actually start heading lower. The dollar's heading lower. Now, normally you would sit there and say, you know what? That's probably a good thing for international, and it probably will. But if you take a look at just the design, if they start raising interest rates, they have 13% in industrial, so they'll be trying to slow down that part, right? And so it's kind of you can make a case for a weaker dollar, where it's going to probably help international just by the conversion of the currency, but because we have such a large weight in probably the next major wave of technology, I would still give the hat tip to the U.S. Even with a weaker dollar, I could still make a good argument that the U.S. the domestic markets will still outperform the international.
And two things to add to that, Bob. The one thing that we have that almost no one else on that globe down below has is the unique combination of both energy and agricultural independence. And because of what we're seeing in Ukraine with Russia and with food supplies and energy supplies, having that tandem of things becomes an enormous tailwind for your economy when almost no one else has that tandem.
Yep, that's that deglobalization, right? Or like the that we're looking at. So that'll definitely trickle into future market insights too. But Jeff and Bob, thanks so much for taking the time to be with us today, and for everyone tuning in. We really appreciate it. We're trying to geek out, and we're looking at all the investments for you, so you don't have to worry about it. But if you have any questions at all on anything we talked about, please feel free to reach out to your local SRP representative. But until next time, we really appreciate it. Have a good one.
Thanks, everyone.
Thanks, everyone.